You, Dr. Hassett. You know, thinking about the lessons from President Reagan's tax reforms and the impact, today we have a code that's actually more progressive. Even though the rate is lower, more and more people are paying on the upper earner side. We have a lower low bracket at 10% rather than 15%. But one of the biggest changes is how many businesses are filing as individuals, as corps, as pass-throughs, as partnerships and all. Some have suggested that we only do, as a country, for economic growth, corporate-only tax reform. But given a view of how much of our job growth occurs on the individual side, how critical is it that we do both?
Thank you, Mr. Brady. The individual side is very important. As you know, that there's an enormous share of aggregate business income now that goes through the individual code. If we have, however, a very solid, smart corporate tax reform, then we would expect, based on analysis in the literature by economists such as Roger Gordon and others, that there would be a lot of change of organizational form. If we made the corporate tax code really attractive, then people might decide to organize their business less through the individual side. I think that's an important consideration if one starts to be constrained, and I'm not an expert on this, and I know the members of the committee are, by political realities that suggest that maybe you have to deal with the corporate reform all by itself. If you have a really good corporate reform, the organizational form issues, I think most economists believe, will kind of work themselves out.
From a job creation standpoint, in the role business investment plays, buildings and equipment software, how critical is it that in addition to low rates, that the after-tax cost of capital be also low from the standpoint of much of our economy from energy on? The goal is to rate. It takes a large amount of capital invested, quickly recovered, and reinvested as well. Very key to that job creation. What lessons should we keep in mind as we go forward?
It makes me, and here I concur with Dr. Gravel, who, by the way, I first met when she discussed a paper of mine on this topic on the investment tax credit repeal of the '86 Tax Act.
I remember that.
but it's a concern that Dr. Gravel and I both share, that if you're going to cut the corporate rate, then the reduction in the corporate rate benefits both old capitals, say a company that's making a lot of money today based on investments they made in the past, they'll pay less tax this year. And it will also benefit new capital, because if you make an investment that pays off, then when you ultimately earn profits on it, you'll pay a lower rate. But the depreciation is only available to somebody who invests in a new machine. If it, like at the margins starting right now, it's the depreciation that I get if I buy a new machine that has an influence on my decision. And so if we have a revenue neutral reform that increases the tax on new capital and then reduces the tax on new and old capital, then it necessarily on net has to increase the tax on new capital. And in the kind of models that I've used throughout my career, the kind of model that Dr. Gravel used throughout her career perhaps as well, at least the career since we started interacting, that could be a negative for growth if you're not careful.
All right, thank you, Doctor. Dr. Tyson, given the competitive climate we're in worldwide, is it possible to remain competitive and have a pro-growth tax code retaining a worldwide form of taxation for corporations?
I do not think we should. I think that what we have in our worldwide system, we have a worldwide system which has a lot of particular features which have encouraged and allowed our companies to overcome the competitive disadvantage associated with the worldwide system, essentially by taking advantage of deferral and other options to keep money outside.
We've tied ourselves in
So basically, we get no revenue. We don't get the money for financing investment and employment in the United States. So we get none of the benefits. A territorial, moving to a partial exemption system with some serious base erosion, and Dr. Hassett and I agree on this, we get rid of the competitive disadvantage our firms face. We get rid of the competitive disadvantage of locating here, and we get the benefits there of competitive advantage vis-a-vis the rest of the world.
It just seems in this world that when our companies compete and win overseas and have profits, we have a tax gate preventing them from bringing them back and reinvesting in U.S. jobs, U.S. research, U.S. growth.
Absolutely.
Makes no sense at all.
It makes no sense.
Thank you. Governor, I want to ask you the lesson to us from your experience as we go forward in tax reform Is there one key message we ought to keep in mind as we pursue this?
Yes, sir. First of all, I happen to agree with Dr. Tyson about this issue of the repatriation of capital. I have been personally involved with corporations that have been very proud of the fact that they've moved their capital overseas so that they can increase their reports to their shareholders, and they're rather happy about it because they understand that they're tax advantaged by going overseas. That's something that has to be changed and has to be repaired. If we can bring the money back for our companies to get them invested in the United States, why do we insist on penalizing that? I agree with Dr. Tyson. Now, secondly, if you ask me a question, let me also mention also that as part of our growth code, we think an innovation would be to break up this distinction between small businesses and individuals and corporations. You can tax all people on business activity the same and eliminate this pass-through where small businesses are disadvantaged in passing through to higher individual tax brackets as part of an overall program which we've developed called the Growth Code on our website. You asked me a question, Mr. Chairman, and I congratulate you, by the way. I think you're one of the congressmen who actually understands what's going on around here, and we appreciate very much your having this hearing to push this forward and to do this. There's one question, one point. It is this. Net growth must become the national goal of the United States of America, and we should not do anything that discourages it. We should do everything we can do to encourage it, at least until we get the revenue going again. And what have we done? Well, we've raised taxes on the higher brackets to make sure that the people don't invest, even though you won't see the revenue because they can get away from that. We have increased the taxes on capital gains to make sure nobody will create any capital gains. You're not going to see any revenue from that, but we're discouraging the investment. We've done a sequester. We've done an Obamacare, which makes sure small businesses can increase their employees over 49 people. And amazingly, we have allowed a payroll tax on every wage earner in the United States to make sure that consumption goes down. We have done everything as a national policy to discourage growth, and we have done nothing to encourage growth. My message is that that must become the national challenge.
Thank you, Governor. Representative Delaney.